Good morning and a warm welcome to everyone. And thank you for joining this webinar about residential property income for individuals, expenses and deductions. My name is Graham and I'll be co-presenting the webinar today along with Samantha. And the webinar will last for around an hour. The information you'll be receiving today is correct at the time of delivery and today's date is the 11th of June 2024. Guidance is updated regularly, so we advise you to refer to gov.uk for regular updates. So I'll start by explaining how to use the control panel and ask questions. If you're watching on a PC, laptop or Mac, you'll have a control panel like the one on the screen now. Near the top of the control panel in the audio box, you'll see the red muted message, and everyone's microphone is muted so you can hear both myself and Samantha clearly. You can also adjust the sound from this audio box. There's a message at the top right-hand side of the screen for anyone who can't hear me. And you can usually fix audio problems if you select the phone call button and then make sure you go back and select the computer audio button again. If this doesn't solve the problem, we suggest you close the webinar and log back in. Halfway down the control panel is a handouts box, and the handouts will include links to the information being covered in the webinar today. You can download these at any point during the webinar, and they are provided in two formats, Word and PDF. So please download in whichever format you prefer. There's a question and answer box near the bottom of the panel. Type your question in the box and then send. You can make the question box bigger by selecting the symbol at the top right of the question box, and you can then resize the box. Before you leave the webinar, you can choose to save the question and answer log. For those using a PC or laptop, on the control panel, select File in the top left-hand corner of the control panel and then Save Questions log. For Mac users, on the GoToMeeting toolbar, select File and Save Message log. And I'll repeat this and also show this slide again at the end of the webinar. Note, a link to a recording of the webinar plus useful links will be sent via email to you within a couple of days. If you're joining us on a phone or tablet, you may see a toolbar instead of the control panel. In that case, tap on the question mark to ask a question, and you should take a screenshot to save answers. We suggest you do this as you go along, as you will not be able to save the question answer log on a mobile device. Tap on the document icon to download the handouts, and the icon should already have appeared, as the handouts are available for you to download. If you are unable to download the handouts, the links will be included in the follow-up email you'll receive in a few days. During the webinar, we have colleagues in the background answering your questions using the control panel question and answer box. They will aim to answer as many of your questions as they can today, but may not be able to reply to them all. Please note that we're unable to answer questions specific to individual circumstances. So for that reason, can we please ask that you don't post any personal information in the question box. And finally, if we have any groups of attendees today, could I please ask you to use the question box to tell us how many additional people are taking part. For example, if there are 3 of you taking part as a group, then please type 2 in the question box. And I'll just give those of you who need to provide that information just a moment or so to do that. So thank you for providing that information to us. So in today's webinar, we'll cover expenses and deductions for residential property, including revenue and capital expenses, repairs and improvement costs, expenses before you start letting your property, mortgage and finance costs, travel costs for business journeys, and replacement of domestic items relief. Today's webinar doesn't cover the basics of letting property. Our webinar, Residential Property Income for Individuals, an Introduction, which is being delivered live at 1:45 p.m. on Thursday, the 13th of June, covers what we mean by income from property, furnished holiday lettings, when to record income and expenses, the property income allowance and the rent a room scheme. So do please feel free to register for that webinar should it be relevant. So at this point now, I'm going to hand over to Samantha to begin the main presentation. So good morning to you, Samantha.
Good morning, Graham. Thank you. And good morning and a warm welcome to everyone who's joined us here today. We'll start with the basics for expenses and deductions. To work out your taxable rental profit or loss, you deduct allowable expenses and deductions from your total rental income. However, not all expenses are allowable for income tax. Firstly, expenses must be solely for the property business to be allowable. This is known as the wholly and exclusively rule. Where this isn't the case, the expense isn't allowable. However, where you can show a separate amount or part of the expense is solely for the property business, that amount or part is allowable. You may have a property which you partly let and partly use yourself. Your expenses may cover both the rental and non-rental part of the property. In these cases, work out a reasonable part to use as an expense for the property business. For example, where you let a quarter of the property and use the rest for private purposes, you could claim a quarter or 25% of the expense. You can't claim any expenses for the time you spend on your property business. But if you take on a paid employee to help run your property business, the costs of their employment are allowable as an expense when you work out your rental profits. Make sure you operate pay-as-you-earn correctly, even if they're a family member. HMRC has a wide range of pay-as-you-earn webinars if you want to find out more about this. If you're letting a property at a reduced rate, your expenses may not be allowable. For example, if you let a property to a relative or friend below the market rate. This is because the expenses may not be solely for the purposes of your property business. However, HMRC will allow you to use expenses up to the amount of rent you receive, but not to create a loss for tax purposes. There are two types of expenses. They are known as revenue expenses and capital expenses. It's important to decide which expenses you have as you treat them differently. Revenue expenses are your day-to-day running costs of the property business. For example, advertising, stationery, and insurance. Revenue expenses also include repairs. A repair is where you restore something to its original state without improving it. Some examples are repairing burst pipes, replacing broken windows or doors, and redecorating. Revenue expenses are allowable expenses. You can take these from your property income to work out your profit or loss. However, they must meet the wholly and exclusively rule. Capital expenses are the costs of things you use in the business over a longer time. For example, when you add something that wasn't there before, when you alter, improve, or upgrade something, or if you buy furnishings or equipment for a residential property. Capital expenses are not normally allowable expenses when working out your profit or loss. Keep permanent records of these costs, though. You may be able to claim them against capital gains tax when you sell or dispose of the property. At this point now, I will hand over back to Graham for a polling question. So back to you, Graham. Thanks.
Yeah, thank you very much, Samantha. So yes, we'll now have a look at the first polling question that we have for you today. And this is where you can take part in the webinar by selecting one of a choice of answers. And no one else can see your individual reply, but we'll all be able to see the overall result as a percentage of the total replies. And I will show you this on screen after the poll has closed. Now, your answers are useful feedback for us, so please do get involved if you can. So that first polling question is now on screen. The question being, which of the following is a revenue expense? So please select one from, is it an extension to a residential property? Is it a double bed for a residential property? Or would it be replacing a broken window in a residential property? Now, just whilst you're taking part in that first poll, just a reminder that of what I said at the outset, there is a handout available today. The handout is provided in both Word and PDF. So please do download whichever is your preference whilst you're live with us today. That handout will include relevant links and information following on from this presentation today. So it will be something you can refer back to in due course. So thank you to the very many of you that's taken part in that first poll. The votes are now levelling off. So I will now close that and share the result with you. And I'm pleased to say the overwhelming majority have correctly identified that the answer is C. That's replacing a broken window in a residential property. Now this is a repair and so is allowable as an expense when working out your profit or loss. The other two, that's an extension to a residential property or a double bed for a residential property, are both capital expenses. So I'll now hide that poll from the screen and moving on then. And there are special tax allowances you may be able to claim for some capital expenses. They don't include the land or buildings. The two main allowances are capital allowances and the replacement of domestic items relief. Now we'll cover the replacement of domestic items relief a little later, but we'll start with capital allowances. And you may be able to claim capital allowances on the costs of some capital expenses. For example, a vehicle you use in the property rental business. Equipment like tools and ladders used to maintain the property, and computers and other office equipment used for the rental business. You cannot claim capital allowances for furniture and items you supply for tenants to use in a residential letting. However, you may be able to claim them for items purchased for use in properties that qualify as furnished holiday lettings. Capital allowances allow you to deduct a percentage of the capital expense from your property income to work out your profit or loss. This may be what we call an annual investment allowance, sometimes known as an AIA, or a writing down allowance. If you're using cash basis, the rules for capital allowances are different. There are some exceptions. For example, buying a car, you can include the full amount of the capital allowance as an expense when you work out your profit or loss. This is instead of using an AIA or writing down allowance. More information on exceptions can be found in guidance PIM 1095 on the gov.uk website. Therefore, with cash basis, you only claim capital allowances when you buy a car for use in the business. And we'll look more at motoring expenses a little later in the webinar. So let's look at an example of using capital allowances. And you've purchased the following items solely for use in your residential property business: a computer, a combined printer and photocopier, and a car. When using traditional accounting, you claim a capital allowance for the computer, the printer/copier, and the car. Remember, this is a percentage of the purchase cost for these items, which may be an AIA or a writing down allowance, though an AIA can't be used for the purchase of a car. If you're using cash basis, you should claim a capital allowance for the purchase of the car, and this must be a writing down allowance. However, the full cost of the computer and printer stroke copier can be claimed as an expense against your income. If you also purchased a double bed and some wardrobes for the properties, whether you're using traditional accounting or cash basis, capital allowances aren't available for these costs. However, capital allowances would be available for these items if the property they're purchased for qualifies as a furnished holiday letting. You can find an introduction to capital allowances in the Property Income Manual, PIM 3010, again on gov.uk. As well as deciding if an expense is a revenue expense or capital expense, it's important to decide if an expense is a repair or an improvement. A repair is where you restore something to perform its original function properly. This may be by replacing parts of it. Repairs are a revenue expense, so you can include them as an expense when working out your profit or loss. Improvement costs are a capital expense. You cannot include them as an expense when working out your profit or loss. You may be able to claim capital allowances in some cases. If not, you may be able to use the cost of improvements when you work out any future capital gains tax if they're still in place at the time. So let's have a look at an example. And a landlord has an ordinary tap which is dripping. He replaces the tap which is dripping with a similar kind of tap. This is an allowable expense as a repair. If the landlord replaces the ordinary tap with one that has a pull-out spray head, then this is an improvement because the new tap can perform more functions than the old one. This is a capital expense and cannot be included as an expense when working out your profit or loss. So what happens if a repair does not have a like-for-like replacement? If you use new or improved materials, this is still a repair or maintenance where the function of the asset remains the same after the work. A good example is where you replace single glazing with double or triple glazing. Other examples of repairs that may be allowable expenditure include stone cleaning, painting and decorating, mending or replacing broken windows and doors, repointing, and replacing roof tiles, flashing and guttering. When you buy a property that is derelict or run down, the costs of putting it right are likely to be a capital expense. For example, where the property isn't in a fit state for letting, or you pay a cut price for the property because of its condition. You cannot include these costs as an expense when working out your profit or loss. However, you may be able to use them when working out any future capital gains tax. And that now brings us to the second polling question that we have for you today, which I will now launch onto screen. So the question on this occasion is, which of these is not a repair? Please select one from, is it replace an ordinary tap with a pull-out spray head tap? Is it painting the kitchen cupboard doors? Or replacing damaged vinyl flooring with new vinyl flooring? Again, whilst you're taking part in that poll, just a reminder, firstly, thank you to those of you who've submitted questions today. My colleagues in the background will aim to answer as many of your questions as they can today, but they may not be able to reply to them all. Regarding the saving of the questions, and if you're on a mobile device, then you will need to take screenshots as you won't be able to save the question and answers log. If you're on a PC, a laptop, or a Mac, then I will remind you towards the end of the webinar how you can save that Q&A log. Also, a reminder that you will receive a follow-up email. That email will include a link to a recording of the webinar and also to useful links. And that email will be sent out to you over the course of the next couple of days. So once more, my thanks to all of you that's taken part in that poll. I will now close that poll and share the results. And again, I'm pleased to report the overwhelming majority have identified the correct answer is A. That's the replacing a damaged ordinary tap with a pull-out spray head tap. This is not a like-for-like replacement. It would be an improvement. So it would be classed as a capital expense and not a repair. So thank you. There is one final poll I'll launch a little later, but I'll now hide that from the screen. At this point, I'm now going to pass back over to Samantha to continue on with the next section. So back to you, Samantha.
Thank you very much, Graham. Let's move on to look at expenses you have before starting to let a property. Expenses you have before you start letting your first property must meet all these conditions to be allowable when you do start letting. They must be solely for the property business. This is the wholly and exclusively rule. They cannot be capital expenses. They must be within 7 years before the property business starts. They would be allowable if they were spent after the property business starts. Where the expenses meet all these conditions, treat them as if you incur them on the day the property business starts. After starting to let your first property, costs you have before letting a second property in the same property business are treated as normal expenses of the property business. We're now going to look at mortgage and finance costs. Finance costs include interest on mortgages and loans. This includes loans to buy furnishings. Other finance costs, such as fees and the related costs of getting or repaying a mortgage or loan, are also allowable costs. Only the interest part of a mortgage or loan repayment is an expense. Repayments of the amount borrowed are not allowable. These are known as capital repayments. You cannot use any finance costs from a residential property as an expense when working out your profit or loss. Since April 2020, all allowable finance costs from residential property are used to work out a basic rate tax reduction to your overall tax bill. The basic rate is currently 20%. It doesn't affect individuals who rent out a property that qualifies as a furnished holiday letting. It also doesn't affect commercial property lettings like offices or shops. For these, use your finance costs as an expense to work out your profit or loss. As announced in the spring budget, the furnished holiday lettings tax regime will be abolished from April 2025. The regime will still be available in the 2023 to 2024 and 2024 to 2025 self-assessment tax returns. If you have a loan that's used for mixed property types, only the part of the loan for residential property is used to work out the basic rate tax reduction. For example, a loan used for a shop and the flat above it. In this case, work out a reasonable portion of the loan costs for each type of property. We're going to give you a basic overview of how to work out the tax reduction if you're an individual with just one property business. Most landlords won't have to work out the tax reduction. The online self-assessment tax return will do this for you. We'll show you where to enter your figures on the tax returns shortly. To work out the tax reduction, you need to consider 3 different amounts. The first amount is your total residential finance costs for 2023 to 2024. Add to this any unused finance costs you've brought forward from an earlier year. This is any amount that you couldn't use to work out the basic rate tax reduction in 2022 to 2023. I'll tell you more about this shortly. The second amount is the profits of the property business in 2023 to 2024, less any losses from an earlier year. The final amount is your adjusted total income. Your adjusted total income is usually your total income for the year, less any losses and reliefs, less savings and dividends income, less your personal allowances. So you now have the three figures you need: your total residential finance costs, your property business profits for the year, and your adjusted total income. The next step is to see which of these figures is the lower amount. If you have just one property business, the tax reduction is 20% of the lower amount. If your total residential finance costs are not the lower amount, you aren't using all your finance costs in the year. So you can carry forward the difference between the amount used to work out the basic rate tax reduction and your total residential finance costs. Then you use this in the following year when you work out your basic rate tax reduction. For example, your total residential finance costs are £10,000. Your property business profit for the year is £6,500 and your adjusted net income is £32,750. So your property business profit is the lower amount and is used to work out your basic rate tax reduction. However, you have £3,500 residential finance costs which you've not been able to use, which you can carry forward to the following year. If you have more than one property business, you must work out the tax reduction separately for each of them. If this is the case and your adjusted total income is the lower amount, you need to do a further calculation. This is because the basic rate tax reduction cannot create a refund of income tax. You can find out more about calculating the tax reduction in the Property Income Manual, PIM 2058. To finish off this part of the webinar, we'll show you where your figures go on the online tax return. On the Expenses for Other Property Income page, only show allowable finance costs from properties that are not residential. Do not enter any residential finance costs. On the Profits and Losses for Other Property Income page, show your residential finance costs for the year here. When filling in your tax return, remember that the Help About link under each question gives guidance about what you need to enter. On the same page, show the amount of unused finance costs you have brought forward from an earlier year. The total of your residential finance costs, plus the amount you enter here, cannot be more than your profit for the year. You can carry forward any balance to the 2024 to 2025 tax year. When you view your calculation, you'll find the amounts used to calculate the basic rate tax reduction here. In this example, the total residential finance costs are £18,500. That's £16,000 from 2021 to 2022 and £2,500 brought forward from 2022 to 2023. £11,430 is used to work out the basic rate tax reduction. This is the maximum possible without creating an income tax refund. This means £7,070 can be carried forward to 2024 to 2025. Let's move on to travel expenses you may have. You can claim the costs of journeys between different properties which are solely for the property business. If you run your property business from home, you can also claim the costs of travel from home to the let property and back. However, the journey must be solely for the property business. This could be using your own vehicle or by public transport, for instance, by bus or train. You must make sure that you only claim travel expenses that meet the wholly and exclusively rule. If a trip is for a mixed purpose, none of the expense is allowable. This is because you cannot separate the business and private parts of the journey. For example, if you travel to your rental property and decide to do some shopping on the way, none of the costs are allowable. If the only purpose of the trip is for the rental business, you'll be able to claim the full expense. Here are some examples. Callum and Sue decide to visit their rental property on their way to relatives in the area. They cannot separate the business and private elements of the journey, so none of the travel costs are allowable. Mia is staying with relatives. Mia travels from their relatives to their rental property and back. The business journey is separately identifiable, so the costs are allowable as an expense. Individual landlords can use two different methods to work out their expenses when they use a car, van, or motorcycle for business journeys. They can choose to use the actual running costs and claim capital allowances for the purchase of the vehicle. Otherwise, they can use a fixed mileage rate. You must use the same method all the time you have that vehicle for your business. So if you use the actual costs for a vehicle last year, you cannot use the fixed mileage rate for the same vehicle this year. When you use the actual costs method, you need to keep records of all your running and maintenance costs. You also need to record your annual mileage and business mileage. Work out what percentage your business mileage is of your annual mileage. Use this percentage of your total motoring costs as your allowable expenses. You may also be able to claim a capital allowance for the purchase of the vehicle. The fixed mileage rates are the same as for other businesses. For cars and vans, that's 45 pence per mile for the first 10,000 miles and 25 pence per mile thereafter. For motorcycles, it's 24 pence per mile. These rates cover the whole cost of running and maintaining the vehicle. You cannot claim any other expenses or allowances for the vehicle. Whichever method you choose, always keep full records including journey logs and mileage records. As we said earlier, there are special allowances for some capital expenses. The replacement of domestic items relief is for landlords of residential property. It allows them to deduct the actual cost of replacing furnishings from their property income to work out their profit or loss. It doesn't allow the cost of buying furnishings for the first time, only replacement costs. What do we mean by domestic items? Well, they include movable furniture like beds and freestanding wardrobes, furnishings like curtains, linens, and carpets, household appliances such as televisions, fridges, and freezers, and kitchenware like crockery, cutlery, and pans. Domestic items do not include items that are a fixed part of the property, for example, baths, sinks, boilers, or fitted kitchen units. These may be an allowable expense as a repair to the building, as long as there is no improvement. You cannot use the relief for furnished holiday lettings or commercial property lettings, for example, shops and offices. You can use it for unfurnished, part furnished, and fully furnished residential property. There must be an actual cost for buying a new replacement domestic item. The new item must be solely for use by the tenants, and the old item must no longer be available. If the new item is an improvement, you can only claim the cost of buying an item which is the same as the original. Let's look at an example. Theo has a partly furnished residential letting. A chair needs replacing, so Theo buys a new chair. Theo can use the whole cost of this new chair as it's a like-for-like replacement. If Theo replaces the chair with a sofa, they can only use the amount it would cost to replace it with a chair. The price difference between a chair and a sofa is an improvement. They cannot use the whole cost at this point. If they later replace the sofa with another sofa, they can use the whole cost. This is a like-for-like replacement. Where the replacement is a reasonable modern equivalent, this doesn't count as an improvement. The full cost of the replacement item is allowable. An example would be a replacement fridge with an improved energy efficiency rating compared to the old fridge. So the amount you can claim as relief is the allowable cost of the new replacement item. Where there's an improvement, limit the relief to the cost of replacing the original item. Add on related costs for disposing of the old item or buying the replacement. Then take off any amounts you receive when you dispose of the old item. You can find out more on gov.uk. And at this point now, I will hand over back to Graham for a final polling question. So back to you, Graham. Thanks.
Yeah, thanks very much, Samantha. So yes, as Samantha said, it's now time for the final polling question that we have for you today, which without further ado, I will launch onto screen. So the final question we have for you today is for a partly furnished residential letting. Which one of the following can you claim using replacement of domestic items relief? So is it a replacement boiler, a replacement bed, a replacement bath? Is it none of the above? Or you do have the final option there if you're not too sure or don't know the answer, that you can state that you don't know. So again, just a reminder, colleagues will aim to answer as many of your questions as they can today, but they may not be able to reply to them all. So again, once more, many have taken part, not just in this poll, but in all 3 polls that have been launched today. So my thanks to you all for taking part. Your answers are useful feedback for us. So again, the votes are now levelling off. So I will now close that poll and share the result with you. And once more, the majority of the audience have identified the correct answer is B, that being a replacement bed. Now, domestic items don't include fixtures, and it doesn't matter that the letting is only partly finished. Sorry, partly furnished, I do apologise. So I'll hide that poll off the screen, and we are now near the end of the webinar, and so here's a summary of what we've covered today. We've looked at expenses and deductions for residential property, including revenue and capital expenses, repairs and improvement costs, expenses before letting a property, mortgage and finance costs, travel costs for business journeys, and the replacement of domestic items relief. If you need more help, our full range of help and guidance can be viewed online from your mobile, tablet or PC at any time, and links to further help and guidance are included in the handouts for you today. So now, as promised, just to repeat from a little earlier, and that's if you're using a PC or laptop and you'd like to save the question and answers that have been shared in the questions box today, select File and then Save Questions Log at the top of your control panel. You can also save the question and answers log from a Mac. On the GoToMeeting toolbar, select File and Save Questions. A reminder, if you're using a mobile device or tablet, you need to take screenshots as you are not able to download the question and answers log. The control panel will close at the end of the webinar, so if you want to download the handouts and also the question and answers log and haven't yet, I will give you time to download these at the end of the webinar, and I will leave the webinar open for around 5 minutes to allow you to do this. Just to remind you, we will also send you an email, including a link to a recording of the webinar and useful links, and that'll be sent within a couple of days. When the webinar has closed, you'll be directed to a short survey, and your feedback is very useful and helps us to keep developing our webinars. If I can ask, please now that you do not send in any more questions, as these will not be answered in the 5 minutes that the webinar will be left open. So that just leaves me to thank Samantha for her presentation, also to thank my colleagues in the background who've tirelessly worked their way through many of the questions that have been submitted today, and to thank you for having joined us for this presentation. So we'll now go quiet for your final opportunity to download the handouts and the question and answers log. So from myself, Samantha, and all the team here, thank you very much, and I'd like to wish you the remainder of a very pleasant day. So thank you and goodbye.